Okay, then let's look at this graph again. What if we are given some information on a company stock? We know the beta, we know the return on it, and we realize that the return is actually higher than the return that would be on the security market line, right? So what if we have a company whose stock has a combination of beta and expected return that lies above the line? When a stock lies above the security market line, it means that the return is better than it should be for this amount of beta, systematic risk. Is it a good thing for investors? Of course, because they're paying some money to buy each share and they're compensated more than they should be compensated for the kind of, fluctuations in returns that they are getting with their purchase. So this stock will be very popular, in high demand. And high demand means the price will rise. If the price rises, then eventually things will stabilize because you will be paying more money today, and everything you get in the future, like the dividends, will become sort of a lower percentage of what you paid, which is how we calculate the return. So the return will drop, and graphically, the return dropping means we're moving down, straight down, towards the security market line. And eventually, the market will sort of stabilize itself, and the price will rise high enough to make the return fall low enough so that the point reaches the security market line. And this is where the market equilibrium will occur. And so the fact that currently the stock has a better return than it should implies that the price is too low. And we say that this stock is currently underpriced. So above the line, underpriced. And the opposite will happen if the information we are given indicates that a company's stock lies below the line. This is when everything is reversed. The investors are compensated inadequately for the amount of systematic risk or fluctuations in returns that cannot be controlled by the investor. Right? So they are not compensated enough for the amount of risk that they are accepting when they buy this company's shares. And that makes the stock kind of unpopular. The price will drop so that investors get interested in buying the stock. If you pay less for the stock now, then everything you're getting on the stock later in the future, like the dividends, mathematically will mean a higher percentage of what you're paying for the stock now, which is exactly how we calculate return. And so that means that as the price starts falling, the return starts rising. And graphically, the point that was under the security market line will start climbing up and slowly reaching the security market line. And the equilibrium occurs when the point is exactly on the line. So for this amount of beta, we have the right compensation for it in the form of expected return. And so the fact that currently the price is too high and will need to fall means that this stock is currently overpriced. So to summarize, any point above the line means the stock is underpriced. Any point under the line means the stock is overpriced.